Welcome back, everyone, to another deep dive.
From AI-inspired insights from farmers.
If you're enjoying what we're doing here, we'd love to hear from you too.
Absolutely.
Hit that like button, subscribe to the channel, and definitely leave a comment telling us what you want to see more of on this deep dive.
We're always looking for new ideas, and we really value your feedback.
So what farm-related mysteries are you dying to uncover?
Right.
What questions are keeping you up at night? Let us know, and maybe we'll tackle them in a future deep dive. Welcome to the deep dive. Today, we're digging into something really important, the finances of farming, especially if you're maybe thinking about getting into it or you're just starting out.
Yeah, it's a tough field. Farming finance isn't like your typical small business, is it? You've got government policy, global markets, even the weather throwing curveballs.
Exactly. And the current picture, well, it's got some serious challenges. We're seeing nationwide farm debt around, what, $416 billion?
That's the figure. And farm bankruptcies, particularly Chapter 12s in the Midwest, they were up 12% last fiscal year. It's quite sobering.
Sobering is the right word. And apparently, more than half of all farmers actually end up with a net loss each year.
That really underscores the stakes, especially for newcomers. You've got to be incredibly sharp with your financial planning right from the get-go. It's navigating a whole sector under, well, significant pressure.
Right. So our mission today is basically to boil down insights from some solid sources. We want to give new and aspiring farmers a clear view of the big financial risks and, how to handle them.
Kind of a shortcut to getting informed without getting totally swamped by all the details.
Yeah, exactly. We're going to hit 5 main pressure points.
Okay, so first up is commodity price volatility, how unpredictable prices are for what you grow. Then we'll tackle input cost surges, everything getting more expensive to buy.
Then land equity erosion, that's about the value of your land ownership potentially shrinking.
And credit crunch consequences, basically. Trouble getting affordable loans.
And finally, we were thinking about retirement fund exposure, but the sources don't quite frame it that way for new farmers, so we'll pivot slightly.
Right. We'll talk more broadly about building long-term financial security, diversifying assets, things that definitely are covered and are crucial for resilience.
Okay, sounds good.
Right.
Let's start with commodity price volatility. The USDA calls this price or market risk just the uncertainty about the prices you'll actually get.
And it varies a lot, right, depending on what you're actually growing or raising.
For sure.
And we've seen this played out recently. The Minneapolis Fed noted prices for things like wheat, corn, soybeans dropped quite a bit after peaking in 2022.
Dropped back near 2020 levels, wasn't it?
Pretty much. And the USDA is projecting that might continue, partly because supplies are plentiful and exports are maybe slowing down. It paints a bit of a negative price picture.
So that volatility isn't just like numbers on a screen.
Yeah.
It hits the bottom line hard.
Oh, absolutely. Imagine you're counting on a certain price to make your loan payments, and suddenly, right before you sell, it tanks. That's the reality.
Which really highlights why you need solid financial footing. Farmers National Bank talks about knowing your break-even points.
Critically important.
And reviewing your costs and cash flow regularly. They suggest, what, quarterly? Especially when the market's bouncing around like this.
Yeah, and they make a great point sometimes in those really tough years. Just breaking even feels like a win. It's better than losing money.
They mentioned that happened for a lot of folks back in, 2017 to 2019.
Exactly. And the Minneapolis Fed also stresses, you can't just set a budget and forget it. You have to be ready to adjust spending and update your cash flow projections when those commodity prices fall.
It's about being proactive, not just reactive. Farmers National Bank also had some thoughts on marketing strategies.
Like having a solid plan.
Right. A solid plan, really understanding your production costs inside and out, and cutting out unnecessary spending.
Makes sense. They even suggested maybe selling grain earlier, or if you're going to hold on to it, setting monthly sales goals. It's about disciplined selling.
Okay, let's shift gears to the second point. Input cost surges.
Right. The other side of that market risk coin. It's not just the price you get, but the price you pay for inputs. And that's been a huge strain lately.
Yeah, Farmers National Bank pointed out that the high input costs from 2024 are kind of colliding with these lower projected crop prices for 2025. A double whammy.
Ouch. And market intel really drives home how rising costs for fertilizer, seed, fuel just eat up your working capital faster.
Working capital being the cash you need for day-to-day stuff.
Exactly. And if that dries up, it gets really hard to meet your cash flow needs during the season.
So what can new farmers actually do about these rising costs? Any practical tips?
Well, the New England Vegetable Management Guide suggests some basics, like shopping around. Don't just stick with the same supplier without checking prices elsewhere. Consider alternative inputs too.
Farmers National Bank had some ideas there too, right? Like testing your soil properly.
Yeah, see if you can actually cut back on fertilizer based on what your soil really needs. And look at all your seed options. Don't just automatically go for the most expensive one.
It's interesting. Successful farming even brought up this sort of old school approach.
Oh, yeah. What was that?
Basically, thinking creatively about substitutes if something's unavailable or way too expensive. They compared it to how resourceful people had to be during the Great Depression.
Huh. A good reminder that sometimes you have to innovate with the basics.
Definitely. Okay, third area, land equity erosion. Now, this isn't a term used directly everywhere, but we're talking about the value of the land you own outright potentially decreasing.
Right. Either because your debt goes up against it, or the land value itself doesn't keep pace. And it's tied directly to your farm's overall financial health and, crucially, your ability to borrow more if needed.
That link is kind of implied across a lot of the source discussions on debt.
For sure. And the Minneapolis Fed notes that if your farm income is dropping while your debt is climbing, that equity you hold in your land is, well, it's at risk.
Makes sense. And market intel added another layer, rising interest rates.
Right, because higher interest costs mean less of your payment goes towards paying down the actual loan principal, so you build equity slower.
So managing land itself becomes critical. BTC Bank had some advice there.
Yeah, they stress really thinking through land purchases and leases. Are the terms fair, sustainable long-term?
You need to look at soil quality, water access, whether it fits your farming plans down the road.
And they pointed out that sometimes leasing can be, more affordable upfront or even offer tax advantages compared to buying straight out.
But there's a risk too, right? The Minneapolis Fed mentioned farmland loans getting repriced.
Yes, that's a big one. If your loan rate jumps significantly, your annual payments could shoot up, putting huge pressure on your cash flow. If income doesn't rise too, your equity could definitely erode. Something new farmers with big land loans need to watch closely.
Which brings us neatly to point 4, credit crunch consequences.
Uh-huh. The USDA includes this in financial risk, the chance lenders might call in loans, or just that credit gets harder to find or more expensive.
A major worry right now. Market intel said liquidity, how fast you can get cash, was a top concern for lenders last year.
And the main reason? Rising interest rates again. Lenders get nervous when borrowers look riskier.
Makes sense. Market intel also quantified the hit from interest expenses up 43% in 2023. That's huge. It makes borrowing more expensive and potentially limits who can even get credit.
So knowing your loan options is important. Farm Mortgage Capital listed several types.
Yeah, farm ownership loans, microloans, emergency loans for disasters, operating loans for running costs.
Youth loans, even specific ones for building storage facilities from the FSA. The point is, explore what fits your specific needs. There might be flexible options out there.
And a key theme from both Farm Mortgage Capital and Market Intel was relationships.
Absolutely vital. Build a strong relationship with your lender. Keep them in the loop. Don't just see them as a money source, but as potential advisors.
That trust can be really important when things get tight.
Definitely. Because, as the Minneapolis Fed reminded us, loan repayment can become difficult with falling incomes and those repriced loans we mentioned, especially for farmers already operating on thin margins.
And Market Intel had a strong warning about relying too much on credit when rates are high.
Yeah, it can seem like an easy fix for cash flow, but it can trap you in a debt cycle and hurt long-term sustainability. Even refinancing isn't free. It adds costs over time.
Okay, so that brings us to our final area. We initially called it retirement fund exposure, but as you said, the sources focus more broadly for new farmers.
Right. Let's talk about building that long-term financial security, making your farm resilient to shocks. The underlying ideas are definitely there in the material.
Good pivot. Successful farming really pushed for a whole farm risk management plan.
Yeah, not just financial, but thinking about production risks, marketing, people issues, legal stuff, a holistic view.
They also mentioned building flexibility into your timelines.
Which is smart. It lets you jump on opportunities or weather delays without everything falling apart. Avoid being too rigid.
And for income stability, Farm Mortgage Capital had that interesting idea about crop diversification.
Looking beyond the usual suspects, they mentioned things like hops or hemp, tapping into niche markets maybe.
They also talked efficiency, didn't they? Controlling costs through smart practices.
Basic but crucial stuff. Soil testing, good crop rotation, smart irrigation, paying fair wages if you have staff, it all adds up to sustainability.
And another critical piece from Farm Mortgage Capital, emergency cash.
Yes, have a safety net. Their recommendation was enough cash on hand to cover at least 3 months of operating costs. That can be a lifesaver in a crisis. And one more practical tip came from the New England Vegetable Management Guide.
Ah, the off-farm income idea.
Exactly. Having a family member with an off-farm job, especially one with benefits like health insurance or a retirement plan, can really take pressure off the farm's finances and diversify the household income.
Okay, so pulling this all together, we wanted to offer a kind of bonus insight, synthesizing how you really insulate a new farm against these market shocks.
And the number one thing, echoed by BTC Bank and the New England Vegetable Management Guide, is having a solid, comprehensive business plan. But, and this is key one, that you review and update frequently.
Not just a document you write once and file away.
Definitely not. It needs clear goals, operational details, thorough market analysis, financial projections considering different scenarios.
And different funding options. Plus, it absolutely needs contingency plans. What do you do if production fails? Or the market tanks? Or you face unexpected financial hurdles?
And you have to revisit it constantly, adapt it as the economy changes, as markets shift.
BTC Bank also stressed keeping really accurate financial records. Using accounting software helps you track cash flow, monitor profitability, know where you stand.
And finally, circling back to what Farm Mortgage Capital and Market Intel said, build those strong lender relationships. Talk to them proactively, seek their advice. It's all part of planning and managing risk.
So wrapping up, it's clear farming, especially for newcomers, isn't simple. There are definite financial complexities and risks involved.
Absolutely. But I think the big takeaway today is that you can navigate it. Proactive risk management, solid financial planning, and just committing to always be learning, those are the keys to weathering the shifts and building something sustainable.
And there are resources out there to help. We really encourage you to use them. Extension offices, USDA programs, local banks, online guides, trade journals.
Loads of support available if you look for it.
So maybe a final thought for everyone listening. Just think about implementing even one of the strategies we talked about today. How could that single step boost your farm's resilience against whatever tomorrow throws at you?
Yeah, what's the first practical step you're going to take? Something worth pondering. Thanks for joining us for this deep dive. We hope this exploration has been valuable.
Hitting that like button and smash that subscribe.